Are you looking to learn how to trade futures but don't know where to start? I'm going to break everything down for you in the next 10 minutes. It's going to give you a basic understanding of everything you need to learn how to trade futures. So that way you'll be ready to rock and roll in the. Okay, futures. Real quick crash course on history. Futures was originally created for farmers. The exchange was created for farmers because the farmers who, let's say, they were planting corn, they wanted to make sure that their price was protected. So in the past, like if let's say the price of corn were to fall and the farmers couldn't sell their crops at they wanted to protect their crops, they needed a way to protect themselves. So the futures contract market was kind of created for that. So basically, if the price of corn falls, they can sell these futures and make money while it's falling, so that way they don't lose money on their crops. So they're called hedgers. The second side to the coin, enter the speculator. Fast forward into the in going from the past now into the future, enters the speculator. And the speculators are ones who are willing to accept the risk and create liquidity in the market. So basically, the speculators are willing to take risks to profit. So you got hedgers and speculators. We are speculators. We're trying to make a profit by the futures contracts moving, whereas the farmers, they're still in the market trying to protect themselves, kind of like insurance. So that's a real quick history. All right. So futures, basically they're contracts. There's a buyer, there's a seller. The buyer wants the price to go up. The seller wants the price to go down. If you are a buyer, you are what is known as long the futures contract. If you're a seller, you are doing what is called shorting the futures contract. Unlike stocks, you can buy or sell futures. You could go long or short at any given time, at any moment in time. So the way it works is they're traded on an exchange. The name of the exchange is called the CME Group. That's the most popular one. They're in Chicago, Chicago Mercantile Exchange. And basically, there's multiple products you can trade. Futures market that's open 24/7 pretty much almost every day of the week, and there's multiple products you could trade. You could trade index futures, which are like the E-mini S&P 500, the Nasdaq 100. These are stock market indexes that have futures contracts. Um, but there's other kinds of markets too. There's the precious metals market, like gold and silver futures contracts. There are oil futures, crude oil futures for those who are new. There's Bitcoin futures. There's currency futures like, the euro, the pound, the Australian dollar, Canadian dollar, all these that I'm clicking on here, Swiss franc, Japanese yen, US dollar. And of course, there's the farmers futures contracts, corn, wheat, soybeans. And then there's even the bond market futures, which are like interest rate futures. You got the 2-year treasury notes, the 5-year treasury notes, the 10-year treasury notes, and the 30-year bond futures. So lots of different products to trade, and everything like that. All right, what else? Futures. Each contract has an expiration date. So you can only keep the position open in the futures market for as long until the contract expires. Then you either have to close your position or do what's called roll to the next futures contract. All right, what's next? Futures contracts, they're traded on what's called margin. And the way this works is futures contracts are leveraged investments, meaning it's kind of like buying a house. You're putting down a deposit. Like when you buy a house, you put a down payment, but the house is worth hundreds of thousands of dollars. So they're giving you all that leverage for a down payment. Now, if the price of the house goes up, you sell it, you make a profit. Same thing on the futures contract. So basically, the futures contracts have leverage. And what happens is, let me just log in to show you. So I'm going to create a paper account real quick here. We'll do paper trading on TradingView, hit connect. We'll do a $10,000 account so you get this example. So every contract in the futures market has what's called margin. Now, margin is your good faith deposit to open the position. Everyone must post margin to open the futures position, just like the house. Down payment, you get the leverage, right? Um, so now the exchange sets the margin for each contract. So, for example, regardless of which market you choose, whether it's stock indexes, whether it's gold, whether it's corn, whether it's currencies, you have to post the margin. So each contract, the buyer and the seller posts the margin. So here we go. So let's look at one here. Now, there's different size contracts also. You'll want to learn the size of contracts later. But basically, this is a really popular one. It's called the E-mini S&P 500. It's 50 times the index. So the leverage is 50 times this number you see here, 7,024. So if you did the math, you're basically controlling a $350,000 contract. But the exchange says you don't need to put up $350,000. Just give us like, maybe 10%, and that's your deposit. But there's all so that these are the mini contracts, right? They're the big ones. But then there's something smaller for smaller traders. They call them micro contracts. This one is only 10 times the index. So instead of it being 50 times, it's a lot lower. Now, to see the margin requirement, just click on the symbol that you're interested in. Every futures contract has a different symbol. If you want to know what the symbols are, you can click here where it says futures, and it'll show you all the symbols. Um, oh, one last thing before we get to margin. Every futures contract has a front month. The front month is the month that's the most liquid month. That's the month you always want to trade, the front month. More about that later. So let's say right now I'm interested in buying the S&P 500 right here, 7,022, right? This is the micro contract, not the mini, the micro. I go to buy, and here's the exchange telling me, okay, you're controlling a $35,000 position, but we're only going to require that you put up 3,500 bucks, right? Okay, fine. So let's do it. I created a simulation here of $10,000 just to kind of make it simple. You could put this at 20,000, 50,000, 100,000. I just put it at, I just put it at 10,000 to make it really easy for now. So let's buy the S&P, right? We're going to buy it 7,023, and boom. Okay, we bought that. We are now in the S&P 500. So now, as you see, now you see here 10,000 equity, right? Account margin 3,500. Okay? That's what they're holding. They're holding that. Available funds 6,400, right? What does this mean? The way margin works is you must have in your account at all times the available margin to hold the position, the 3,500. If this account ever drops below 3,500, you get what's called a margin call, and the broker will be forced to close your position, or if they don't close your position, then you will be forced to deposit enough money to bring the account back to the available margin. So now, as you see, the market is moving. Now, oh, by the way, each contract has its own tick value. You'll want to learn the point tick values for each contract you're trading. The E-mini, the micro is about $5 each point. So every time the market moves so here it's at 7,022. If it goes to 7,021 or 7,023, I make or lose $5 per point. See how I'm down $7.50 right now? If I'm making money, then the other guy on the other side of the contract is actually losing money. So let's say the market jumps 10 points. I just made $5 times 10, $50. But the seller of this same contract lost $50. So the way futures works is when you're profiting, the other side of the position is losing, and that's why you're profiting. They're basically paying your profits, or kind of like that. It's kind of like zero sum game is what they call it. All right, what else? So finally, so you're in the futures market, right? And now we're turning positive, let's say. Okay. So you have $10,000, but you put up 3,500 to open this position. Well, you only have 6,000 left. So if you risk too much, and you over leverage your account, instead of opening one position, let's say I was crazy and I opened like 10 of these, right? Now, or five of these or seven of these, now instead of making $5 a point, I'm losing like $25 a point. Really quick, you could start to really get crushed on this available funds you have left. You might lose $1,000 in a matter of minutes. So right now, we're only losing $5 a point. It's not that bad, okay, because we have $10,000. But what do you want to do as a futures trader? Well, basically, if you enter the market here, okay, like we entered the market here at what price did we enter again? Let me see. 7,022. So basically, as a futures trader, we have different types of orders. This is a market order. So the market order buys you in the market, But we also have other kinds of orders called like stop loss order. Stop loss order means it stops you from losing money. It sells you out of the market. So if I buy in at, let's say, I bought in here at 722. Let's say I want to risk 10 points, right? So I'm going to put my stop at 722. So let's put it at 7,012, right? Okay. I can't lose more than $50, right? Because if the market reverses back to 7,022, okay, from 7,022 back to 7,012, I lose $50, right? But let's say that the market moves in my favor. Well, then I can create what's called a take profit order. And maybe if I'm risking 10, so you could do this different ways. Like, let's say you want to risk 5 points, you'll risk, $25, right? I mean, I'm just doing this for illustration purposes, but let's say I risk 5 to 25, but then my profit target is higher. Let's say I risk 5 to make, I risk 25 to make 50, or I risk, 50 to make 100, right? Let's say I risk 50 to make 100. Now we are in what's called a good ratio, 2 to 1. So if I hit confirm on this, now you see, now I can't lose more than $50, but I can make $100. This could happen in 5 minutes. Let's say the S&P jumps up here, you just made $100 in like 5 minutes. But let's say it jumps down here, you just lost $50 in 5 minutes. So depending on how much you leverage the account, is how much risk reward you will receive or lose or make or stuff like that. So that's why risk management is so important, and that's why in all my videos I say never risk more than 1 to 2% of your account on any given trade. So if you have $10,000, you shouldn't be risking more than 200. Um, and we're in that zone. We're only risking 50. But let's say I double the contract size. Now we're risking 100 to make 200. Yeah, 100 to make 200. But if I triple the size, 3 contracts, 4 contracts, you get the picture. It starts to get more dangerous. Um, so that's pretty much the quick version of what futures are, how to trade them. I hope to help some of you who are new to trading futures. And I'm going to make a lot more videos about this later on. But for now, that's kind of like a crash course and introduction to futures. What they are, why they were created, how the margin works, how to trade them, which exchange you're going to use, CME Group, and finally how to place some orders, market order, stop loss, limit order, take profit order, and the different products you could trade. So again, back to risk management. Whether you're trading futures and Forex and prop firms, they're all kind of similar. Never risk more than 1 to 2% on any given trade, and that is how you will survive in the long run. Thanks again for watching, and good luck with your trading.